Financial statement errors, liquidity, and solvency. This is Ken Boyd. So a recent movie theater experience reminded me of the risk of a poorly trained staff and the cost of poor customer service, because hiring the wrong people can impact your financial performance also. We'll get to that in a minute. So it was confusing. I'd ordered tickets online and I had the QR code on my phone for the tickets. There were two kiosks to the left to scan tickets, but neither of them worked. And there was a line at the first ticket window. I noticed a guy inside at the ticket booth at the second window who was standing in front of a black microphone. So I walked up and said, "Can you help me? I have a question about the tickets." Now, the employee had two choices. A, realize that he couldn't hear me because the mic wasn't on, walk around the ticket booth to answer my question so I could get to the movie on time, or simply mouth the words, "I can't hear you," and stare at me. This movie theater employee chose B. I walked inside the doors and found a ticket taker with a scanner for the QR code, got into the movie. And then I mentioned that the theater is owned by AMC, a company that nearly went bankrupt during the pandemic. So pretty frustrating. Management in a public company may feel pressure to create short-term or quarterly results for shareholders. However, since most investors have a long-term investment horizon, 5 years, 10 years or longer, growing sales and earnings over years should be equally as important as short-term accounting focus. And accounting issues require a similar discussion. A qualified audit opinion or criticism from a regulator can cause shareholders to lose confidence in the short term. These issues can damage a firm's reputation and result in a lower stock price. Over time, however, and we've seen this in business many times, a firm can get back on track. A few years of growing sales and earnings, timely reports to regulators, clean audit opinions can rebuild a reputation. So you have to think, where's your focus, short-term or long-term? In 2014, Seeking Alpha, an interesting website, performed an analysis of Hertz, the rental car company that we all know. And here's a quote. June of 14, the company filed an 8K form stating that the audit committee had found substantial errors requiring the reissue and revising of financial documents from 2011 to 13. So that's multiple years, 3 years. 3 months later, the company released that it was being investigated by the SEC due to a severe problem in its internal controls, resulting in tens of millions of dollars of accounting errors. So really bad. Total amount of the accounting errors has continued to grow as of the time this article was written. The mistakes are expected to reduce profits by over $180 million over that 3-year period. And not surprisingly, this upheaval caused a 30% drop in the share price. Restating your financials from prior year, 1 year, hurts your credibility. You found a material mistake, you fixed it, you issued new financials. It happens, it's not the end of the world. It happens to well-run companies. However, reissuing financials for multiple years can be devastating. So why? Your shareholders, after all, relied on your original financial statements. This is the problem. Shareholders decide to buy or sell stock. Bondholders may have purchased debt, all based on the originally issued financial statements. So there's really two questions to consider. Can I rely on management to issue accurate financial statements moving forward? And can the company grow sales and earnings? In other words, can the company make themselves more valuable by being more profitable? So let's take on the second bullet point here. One thing to ask a company's financial reports, to analyze a company's financial reports, is to consider financial ratios. And you can separate them, broadly speaking, in two groups. So first, liquidity ratios. These are short-term ratios. Think about the company's checkbook. And in this case, can Hertz generate enough cash to operate over the next 6 months or a year? The most common ratio is the current ratio, which is current assets divided by current liabilities, which answers the question, can the firm generate enough cash, collect receivables fast enough to pay its bills, its current liabilities? And most important of all is the firm generating cash from operations, day-to-day business operations. Hertz, for example, is in the business of renting cars. Can they generate sufficient cash inflows from renting cars to operate? Because if they have to sell assets to survive, they're probably not a viable company in the long term. Solvency ratios have a long-term focus. One of those ratios is capitalization. How much of Hertz's capital was raised through issuing stock, which is equity, versus floating debt? because the more debt that's issued as a percentage of your total capitalization, which is stocks and bonds, the more earnings are needed to generate to pay interest and repay principal on the debt. Just like somebody who's personally in heavy debt, that's a risk. A company in heavy debt position is also a risk. So take a step back, take a deep breath, and do some analysis if you're dealing with a company in this situation. Once you get past the accounting errors and restatements, where does the company stand financially? Can they perform so that investors regain confidence in management and maybe buy the stock? You can use liquidity and solvency ratios to figure this out. And try to bypass that ticket window because the person with the QR scanner is inside the theater. For more great content on accounting and finance, you can go to accountingaccidentally at substack.com, where you'll get more of this content. Thanks.